over the last 12 months, how many of you have bought or sold stock through an online brokerage firm? All right. Now, how many of you have invested in commercial real estate over the last 12 months? Exactly. So we're going to talk a little bit about, if I can figure this out. Yes. We're going to talk about why we do what we do at Cadre, what we're up against in the industry as it stands today, and how we are building a data-driven investing platform. At the risk of, there we go. At the risk of stealing my own thunder, given the question I asked earlier, the chief reason we do what we do is because we want to unlock access to an asset class that's traditionally been fairly opaque and generally out of the reach of most people. We're building the company to create access for a much broader base of investors than is currently possible to what is typically referred to as alternative assets. And those assets are typically non-traditional investments that tend to be very illiquid, they tend to be very complex and harder to value. Today, we start from a subset, if you will, of that overall asset class, and we help people invest in commercial real estate. It happens to be one of the largest asset classes in the world. You can think of others that fall into that general category: energy, transportation, and all sorts of infrastructure. It's also one of the asset classes that is performing the best. It's outperformed the S&P 500 for the past 30 years with only half the volatility, for instance. So it really is both a huge asset class and it's one that's very profitable. So you're like, that's great, except very, very few people can actually invest, right? And that's exactly why we embarked on this mission. How do we solve that problem? Because we think that more people should be able to participate in that asset class. When you think about, multi-generational sort of wealth building, that's one of the things that essentially pops up, all the time. And so what we set out to do is to effectively build the first stock market equivalent for that asset class, okay? What is the current state of that industry today, and why is it a problem that we thought was worth going up against? I don't know how many of you work at startups, but if you've ever raised money from venture capital, you know a lot about what we do already. Just in your head, every time you hear me say building, replace that by startup, and you have something that's very similar, right? The ecosystem for us has very similar investors, or at least as the starting point, right? What you don't see here is anything smaller than a very large family office or a pension fund or an endowment, right? And that's exactly the problem. On the opposite side of that so-called two-sided marketplace, you have operators, people whose job it is to identify buildings they want to buy them with the help of investors, and then run them, right? So that's the ecosystem as we know it today. The issues in that ecosystem are that everything that happens is eminently very manual, very intensive in terms of labor costs, and there's a lot of friction in everything that happens, right? So the marginal cost of either raising capital, of deploying that capital into an asset, or of managing that capital once it's deployed in an asset is incredibly high, right? And it's kind of interesting because I mentioned earlier that the industry is actually a very large one and a very profitable one. So as a result of that, there's a massive amount of pressure to invest in the asset class, right? And so what you see is an ecosystem that's slowly but surely backing itself into a corner where it can only afford to invest with the largest institutional investors because if there's so much friction because everything is done manually, I can't afford to engage in a fundraising activity with someone who's going to write a $10,000 check. I'm trying to raise billions of dollars every 3 to 4 years, so I can only engage with the actors that I mentioned earlier, the pension funds that can write, anything north of $25 million, $100 million, right? And so you have this sort of self-reinforcing cycle where you start dealing only with the largest investors. It's kind of something you get hooked on, and then you seek larger and larger amounts, right? Kind of similarly on the opposite side of the equation, right? Like now that you've raised, a $5 to $10 billion fund, you need to deploy it. It's a big problem, right? So first of all, you're going to be looking for very large assets. Second of all, the due diligence process, is very, very costly, right? You're not going to rush through that. You want to make sure you're doing it right. And today, it comes with a lot of friction, right? And then similarly, now that you've acquired an asset, you need to manage it. You need to make sure that there's good governance. You need to understand exactly how the operator that you're partnering with is actually managing the asset. And that's something that ultimately rests on the constant flow of data back and forth, right? You want to understand, how much you're charging for rent and the occupancy rate and that stuff. And if, that's something that you have to do manually, again, it's very expensive, okay? Similarly, you have a trust model that is very much built on relationships, right? And again, you have these entrenched situations where, because we've done business before, it's tempting to keep doing business together. So you have a situation where the network effects are not really playing in your favor, right? You also become extremely entrenched in your domain expertise. And so now you're becoming a specialist about a very small subset of the market. And again, everything perpetuates, right? So that's the state of the union, so to speak, that we are, going up against. As you can imagine, right, we're talking about real estate. So unlike the stock market that's moving throughout the day and that's transacting very frequently at very high volumes, here you're looking at, a very different situation where you have very few primary transactions. And so as a result, while the model is very data-driven, we want to understand how revenue is going to grow for a piece of real estate because that's going to determine ultimately how much I'm willing to pay for it. Because data is sparse, right, it's really hard to actually analyze the shifts that we're going to see over time between supply and demand imbalances. And so because of that, everything kind of relies on intuition, okay? The situation as a result, right, of everything I've just described is that if you're an investor, your options are limited when you want to invest, in real estate, right? Funds are essentially what I've been describing, right? It's great if you happen to be a pension fund. It's great if you happen to be a very, very large family office. For the rest of us mere mortals, mostly inaccessible, right? On top of that, high fees, and you also don't get any discretion. Once you've decided that you wanted to invest in a fund, that's pretty much the last decision you made for a significant amount of time. And you're also trapped in that fund for the next 10 years because there's no way for you to get your money out, right? REITs perform at a lower type of yield, right? And then, of course, you can go and invest directly in real estate and buy a house across the street, but that's adverse selection right there if you ever saw it. It's also not great for the operators because they have very restrictive sort of like funding terms. They are very bounded in time, sort of like lockup periods. And then the tools that they have at their disposal are also limited, right? So that's kind of like what we decided to embark on as our mission. How do we solve that, right? And what I'm going to focus on now is sort of like in a very humble way, the approaches that we are taking to include a much bigger sort of like quantitative element to the industry, right? Our ecosystem is in a way very similar to what I've described earlier, except we also introduced the notion of secondary transactions, which today are extremely rare in the industry. We also expand the group of investors we can work with, right? We want the whole idea, the reason we get out of bed in the morning is to make sure that over time, anyone can invest in that asset class, right? We want to make sure that in order to do that, we achieve some of these key characteristics for the asset class, right? We want to create more discretion. We want to create liquidity so that you can get in and out of your positions and not have to wait for 10 years. And we want to maintain the stuff that's actually good about the asset class, right? Similarly, we want to turn on their heads all the downsides that I mentioned earlier for operators and turn them into pluses, right? So how do we do that? So number one, we believe that it's possible. Number two, right, we believe that from a liquidity and efficiency standpoint, the way you do that is through automation, right? So a lot of what we do revolves around simply like taking processes that have been manual and that have been labor intensive and turning them into pieces of software so that we can lower the friction in the entire marketplace, right? So on the demand side, how do you lower the cost of raising a dollar? And on the supply side, how do you lower the cost of deploying and managing that dollar, right? The key thing I touched on earlier as well is that today, the only types of transaction you see in that ecosystem are primary transaction, right? Which effectively the equivalent in the stock market would be every time someone wants liquidity out of the market, the company would need to be sold to somebody, right? Whereas you and I can buy and sell, trade shares of any stock today, and the company doesn't know any better, right? When it comes to creating transparency, that's where data really comes into play for us. And I'm going to talk a little bit about sort of like the types of challenges we're facing, how we're playing a role today as a curator, right? A lot of the situation arises in this asset class because most people don't know whether a particular building is mispriced or whether it's even in the right market, and so that's the function we perform, right? And over time, how do we expand sort of the insights we produce internally to an outside audience so that they can benefit and gain confidence and actually trade much more freely, right? I'll tell you, it's early days. I like to joke that the journey is about 1% complete, right? And I'm sure like when we get to 2%, I'll discover that there's twice as much. But one of the core issues with what we deal with is that, again, volume in terms of transaction is much lower than what you see in the stock market, right? And so we have to think about proxies all the time. How do we get a sense for what's going on in the market, even though you don't have a lot of data points to observe directly, right? Like think about a zip code, even in New York, and like how many buildings sell each year, right? It's literally, less than 100, right? So what we look at is like demographic, economic, financial, and real estate data, right? That give us a sense for what's going on in these particular markets, right? Of course, you have subclasses of real estate, office, residential, right? All the data that comes our way comes in very different sort of like levels of temporal and spatial granularity, right? Some of that stuff happens at the zip code level, the sub-market level, the market level, an MSA, which is essentially even bigger than that, the state or the country, right? And then temporal resolution, as you know, census data, for instance, is every 10 years, and then you have interpolations in between, right? So how do we essentially, as a small team, there's only like 50 of us at the whole company, how do we essentially equip ourselves to get our hands on all this data and starts to create insights for ourselves so that we can be better curators, and then over time for outside constituencies, so our clients and our operating partners. I'll give you a few tidbits as to what we've done to date. Again, keeping things very simple, how do we automate the work that our teams, who are essentially constantly looking for different geographies to focus on because otherwise the universe is too vast, as well as how to price assets, how do they form an opinion and how do they inform their own intuition with better data? And so the first thing we did is just automate the aggregation of that data. And so we created a report and we actually used tools that are, the UI is probably the ugliest UI I've ever seen, but it doesn't matter because it's just for our own internal use. And so if you punch in an address, you get a bunch of data points that essentially allow us to form an opinion instantly as opposed to have to spend hours getting this data from different sources. So what that means is, again, scaling through automation makes all this happen automatically, instantly, right? And so there's a bunch of these reports that we get our hands on, right? And then the thing we did next is how do we create ideas about which markets to go look into, right? And so for that, what was interesting is that when you want to start stitching together different data providers, they never give you the data in ways that are easy joined, right? So someone is going to give you zip code level data, someone's going to give you market level data, and they don't even overlap. So I'll give you an example, right? This is a neighborhood in New York. That's actually where we are right now. This is axiometric data about residential information, right? And we want to join that with, let's say, median household income in a particular neighborhood. And the problem is that the orange thing is the same thing it was earlier. And that covers like 10 or so zip codes. And how do we do math on that? And so what we end up having to do is like very basic stuff. These are how many households are in each zip code. These are the median incomes in each of those. This is how many fall within the market we talked about. And now the composition of like each, or the contribution rather of each zip code to this market. And with that, we're able to then do the weighted average and get the median income. It's really simple, but you have to do it for everything so that you can get to a place where you can now do interesting stuff across all these dimensions that will join like demographic data, economic data, and whatnot, right? And so I'm sure you guys have seen Google Sheets lately. We literally use their UI. We feed all the data through our system, but then you use that because it's so flexible, and our acquisitions teams are actually very used to working in Excel, so give them something they're used to. And we can start looking at all these things across all these markets, right? And start having them opine as to what they think really matters. And then it gets interesting because now we can train a model on that, and we can come up with our own view of what the ranking might be. And so what we're trying to predict here is revenue growth, right? How much do we think a market is going to grow in terms of revenue over the next 1, 2, 3, 4, 5 years, right? And then it gets really interesting because what we do next is we actually try to compare our model with the intuition of the people on the team. And so now we're auditing our own intuition and we're evolving it. So we get to this thing where we're comparing. There should be a map here. I don't know if you guys can see it, but we took all these markets and we have the survey of the people on the team and the score we came up with as a model. And we're trying to see where we are more optimistic or more pessimistic than the team. And from that, we're having interesting discussions. What's missing in our model? How do we learn better, right? So that's the kind of stuff we do. And that's it. That's what I wanted to cover. Thank you.
Thank you very much. Since we're a little over time, I'm going to pass on to questions directly. Yeah. It's truly a really interesting company. You guys haven't been at it for that long, right?
It's just under 3 years.
Just under 3 years.
Yeah.
So very, very nice. Right.
So it seems to me that you're intervening into a market that has a lot of imperfect information and a lot of like pairwise relationships based on trust and reciprocity and things like that. So there are going to be intentional agents in that market that are benefiting from the limited information there. So I'm curious about how you intend to respond to those actors with the increased transparency that you're trying to introduce.
Yeah, it's a great question, and it's also it's interesting because I often fall back on sort of what we all take for granted in the stock market, right? You get a lot of transparency. And in exchange, you get a lot of liquidity, which is great for people. So I'll give you an example. When it comes to operators, one of the things that really limits their ability to operate and to function is the fact that because typically their equity comes to them, through funds who have limited partners, the only path to liquidity for those limited partners is essentially selling the building, which means that you can't really hold it for more than 5 years, even though you may be doing great in terms of how you're managing the building, and the building might be performing well, you have a team that's running very smoothly, but you need to exit because you need to create liquidity, right? One of the things that operators view as the holy grail is permanent capital, right? If I don't feel like I need to sell this building, why should I, right? And the only way you do that is if you actually create a secondary market, right, where essentially a stock exchange where people can actually rotate out of their investments without having the operator do the same, right? And so it's a trade-off. Like at some point, you're gaining more by doing that, and that's certainly the bet we're making.
Thank you. One more. Yeah. One over here. Oh, hold on a quick second, and Andrew's going to give you a mic.
So given the long-term nature of commercial real estate investment, right? Totally understand the need for that permanent capital for the secondary market. But there's another angle that it could be a result of adverse selection. So those who actually go into secondary, for those who own this and who are entrenched in the system, would only allow the secondary market for the relatively poor investments. Meaning, so the smaller investors that you are actually providing access to would only be able to get in by looking at the lower quality investment. What would you say to that?
Yeah, so it's a great question again. The way this works for us today, right, is that the first thing we do is we underwrite every asset, right? And just to give you a sense, we look at 1,000 assets a year, and we only end up transacting and bringing onto the platform about 20 of them. So think about 98% as a reject rate. And those we actually initially take the financial risk ourselves. We say like, we like this asset, we're going to transact and we're going to bring it onto the platform, right? And then we syndicate, that asset to our investors. And over time, every single one of those will actually be tradable on the platform. There's no selection after that, right? Because it's like any market, right? Today, I think that Amazon is underpriced and you think that it's overpriced. And so we're going to find ourselves in the middle and we're going to find a price to trade at, right? And, that's part of the trade-off I was referring to earlier, right? By getting liquidity, you also get more price movement, right? Which is scary at first for an operator. Like, oh, wow, what does that mean? I need to let the price fluctuate based on the market. But we know that over time it becomes more efficient.
We have time for one more if we have one. Otherwise, we'll just move on. This one here. Oh, whichever one. Raise the hand first.
Hi, thank you. My question is about kind of tying together the data insights that you mentioned, that you were describing to the initial goal of eventually creating access to, even individual investors. So could you help bridge kind of the line of thinking about how the data insights that you're collecting and providing to the clients would eventually create that?
Yeah, absolutely. Again, I think of all of this as like reducing friction in the system, right? If I need a team of 50 investors to deploy effectively into high-performing assets, random number, $1 billion, right? All of these are costs, right? They're fixed costs that essentially allow me to operate the marketplace. If I can essentially do the same with a tenth of the size of the team, I've created more efficiency. And what better way to give confidence and to create velocity for that investing function, than to augment what is typically today intuition, with data. You build confidence, you allow people to essentially target specific markets or geographic areas that they want to focus on, as opposed to waste their time, randomly looking at like every possible asset out there, right? So that selection function, that curation function is one that accelerates, the work of doing the due diligence we need to do. And because of that, we reclaim efficiency for the whole system, for the whole marketplace, and it makes it, cheaper to run, i.e., more accessible.
All right, on this note, thank you very much.
Thank you so much.